The last few years post-COVID has been a volatile time for global stock markets. Compared to the US or China stock markets, the local SGX bourse may seem less exciting. It's built on value stocks and bank stocks that are defensive in nature. Such stocks offer stable earnings and consistent dividends. So is such stability necessarily a bad thing?
Boring could be good at some points in time, just like exciting could be good at some points in time. The reason is because the market moves in cycles. So you have different strategies that may be more effective at certain phases of the market. So for example, if the market is in a downturn, you would prefer boring. So that would generally mean defensive stocks, right? So consumer staples, things like everyday products like shampoo, soap. So even if a person has been retrenched, unemployed, the person is probably still going to continue taking showers, and you need shampoo and soap. So that kind of products are evergreen, as in people will always buy them. But obviously, if the economy is not doing well, and we ourselves are not doing well personally, we're not going to go off and buy Bitcoin or Tesla, and the kind of more crazy stuff, right? So boring is good at some points, exciting is good at some points. There's no, for example, catch-all.
In fact, SGX says it is a misconception that the local market is boring for investors.
I think it is wrong to say it's boring because in actual fact, this is one of the most diverse stock markets in the world. We're not just diversified by the number of industries and sectors that these companies are representing, but when you look at the regional revenue reach in terms of where many of these Singaporean companies are generating their revenue across the region, that introduces a whole new level of diversification as well, which can smooth out, obviously, your impact on big benchmark indices as what happens in one country can offset what's happening to another through the stock market.
Although SGX lacks the size of other larger bourses, and it has been plagued recently by a spate of delistings, there are still large international companies that are listing here and providing interesting opportunities for investors. Last year, Philippines-based liquor giant Emperador and Chinese electric vehicle maker NIO both began trading here. SGX says there is still money to be made here.
But when you do break it down, there are a lot of strategic flows going to work every day in our stock market, targeting specific themes that are highly relevant to investors across the world, whether it's the banks and the impact of higher interest rates on their net interest income versus the impact of decelerating growth on their non-interest income and their loan growths and their non-performing loan ratios, whether it's the slowdown we're seeing in global manufacturing on the electronic side, albeit the strength we're seeing in transport engineering. 20 cents in every dollar that goes to work in our Singapore stock market every day is going into these manufacturing related businesses. And there is overlap there with the whole sustainable infrastructure driven theme. Then of course you have 20 cents in the dollar going to work in our REIT market as well. And then you've also got a number of companies in Singapore, not just in manufacturing segments, really embracing strategic transformation.
Experts say there are many benefits to investing in your local market.
One of the key things would be the FX risks, right? If you're investing locally, you don't have to undertake any of those foreign exchange risks that might come into the picture if you invest abroad. I think it's also a matter of familiarity, how well you know the business. Being based in Singapore, you potentially would understand the business and the risks around it a little bit better than you would understand a foreign business as well. And I would say lastly, I think of course there are many other costs that come into the picture if you're looking to invest outside of your local markets. FX is one thing, but beyond that there could be some brokerage commissions, there could be compliance costs, taxes.
And what are some tips for those who would like to increase their exposure to the local market?
One of the sectors that has not been getting a lot of love from Singapore retail investors is basically the REIT sector. So it's a little bit boring because we always talk about REITs and, so it's same old, same old. But the challenge with the Singapore REIT sector is that it had to compete with the high deposit interest rates that you get from just putting into a normal fixed deposit or buying a Singapore savings bond. That is going to change simply because the macroeconomic environment is changing, US Fed policy is changing, interest rates are going to be changing. So at some point, perhaps later this year or early next year, the yield that you're going to get in the Singapore REIT sector is probably going to outperform what you have been getting in your Singapore bonds.
I think there is potentially scope for a lot of specific sectors of REITs. I would say, something like retail REITs to look very attractive from here. And also, with the buzzing AI theme, I think the data center REITs are also gaining quite a bit of traction. I think the demand for data centers could continue to increase as more and more companies invest in technology, invest in artificial intelligence, and they would continue to need space to store their data, store their servers, and that means that data center REITs could potentially be a very attractive opportunity as well.